Eric here from 5minuteinvesting.com, and in this video we want to talk about EPS manipulation or earnings manipulation. Now, we know that companies are audited, and earnings per share or earnings, it's revenue minus costs equals profit. Now, in a way, this equation is extremely simple, and you might think, okay, well, if the auditors looked at it already, then there shouldn't be any manipulation, right? But that's my diagram for a company. That's the best I can draw. So, company. But even if the auditor looks at it, there is still potential ways for management to manipulate this figure and boost the profits, because management knows the higher the profit, the more investor they'll attract, and the more money they can make because they can boost up the stock price. So when you're investing in a company, you want them to be conservative with how much money they can make. So in this video, I just want to go through a few things they can do to manipulate. Revenue. Out of all of them, revenue is probably the hardest to manipulate because they don't have a lot of different line items. The only thing they can do is really to recognize revenue early. For example, let's say you are a utilities company and you enter into a contract with the government to sell them water for the next 10 years. Now, because you know that this contract is worth $1 million, instead of recognizing revenue as you sell them water, you just recognize the entire contract in one go. So you recognize $1 million in year one. 1 million. Versus the way you're supposed to do it, which is 100K, 100K, and so on for 10 years. And this is usually how they can manipulate revenue, by recognizing it early. But generally, auditors will catch that, and that's pretty hard to manipulate. So, the second one, costs. Now, this is where things get really interesting because there's a concept of property, plant, and equipment. So what happens is, let's say you buy an equipment and it's worth $1,000. Now, you can just expense the whole equipment in here, 1,000, right? And this will lower your profit by 1,000, or you can put this equipment on your books for $1,000 and you recognize it over the life of this equipment. So let's say you expect to use this equipment for 5 years. So what happens is, instead of recognizing $1,000 worth of expense, you recognize $200. So you see how this will increase your profit by $800 because you're recognizing less expense. So this is how they can usually manipulate the profit figure. Now, of course, there are other ways of fraud, but this is usually a grayer area for tech companies. Now, it is really important when you look at growing companies like tech, if they're developing any intangibles. For example, a brand, a software, or a website. A conservative company would expense all that cost to profit. So as of this video right now, I think Amazon expense all the costs, which is a good thing because it's conservative. So then your profit will be lower than your competitors, but over the long run, you're not doing some weird capitalization and trying to defer your expense by putting it on your books. So when you're looking at EPS, earnings per share, which is profit per share, you want to think, okay, is this fluctuation just, a regular fluctuation where there's some change in cost, or management is on purposely trying to manipulate it? That's why when I'm looking at EPS, because there's so many ways to manipulate it, I always double check with other indicators where it is news, whether that's insider activity like management is buying or selling, or you look at other parts of the financial statements to make sure everything looks normal. Because the last thing you want is to invest in a company that has a boost in profit because somehow they changed their accounting policy or somehow they recognize costs later than it should be, which leads to a boost in profit. And a lot of investors, without actually going through the details here, they will think, oh, a boost in profit means good. But that's not usually the case. So that's all you need to be aware of. So just make sure you're not developing your entire investing approach based on this one metric, because it's very easy to manipulate it, and management always get paid based on the amount of profit the company makes. So they have all the incentive in the world to boost profit. And that's it. Like or subscribe and leave a comment below if you have any questions. Good luck.